Well, good morning, gang. Today's February 13th, and we've got more news. And again, the theme of today is I hate to say I told you so, but remember I told you this coronavirus, there's no end in sight? Well, this morning we have a report. It says global shares mostly lower new China virus case spikes. Well, here's the deal. China reported more than 15,000 new cases, 254 more deaths. The jump was apparently due to a new reporting technology. And this is exactly what I'm talking about. When you have a new virus, it's very hard to maintain it, control it, and to see the end in sight. It's very unforeseeable. You're dealing with a live organism. You're not dealing with a piece of machinery or a contract between two people or something that's computer related. You're dealing with people's lives. So there's a steep trajectory towards more risk, all right? And this is not going to help the world. This is not going to help global economy. And China is hurting right now. Just think, they thought there was 30,000 deaths. There's now, or roughly 30,000 deaths. There's now 15,000 new cases and 254 more deaths. So things are not under control with this coronavirus. Not even close. That's what we have in global news. Last few months, what do we have driving the market? We had the trade war with China. Finally, as soon as that's resolved, we had Iran. That lasted about 2 days, and now we have this coronavirus. But this is scaring me. This is dangerous because, again, we don't know the full impact of it. We don't know all the details. We don't know what's going on. Think about Chernobyl. It took us months, literally, I think 6 to 9 months to figure out exactly what happened. And China is they like to hold things close to their vest, if you know what I mean. So that's global economy. U.S. economy, we've got jobless claims today. The numbers are going to come out in about 7 minutes. I thought about waiting and giving you the report afterwards, but honestly, the numbers have been so solid. They've been so in line with estimates, and unemployment has been so low that I'm really doubting that the number's going to be outside of estimates. Consensus between 210, 214,000. The truth of the matter is, anything below 230,000 is not going to be anything to even spark anyone's concern. The numbers are smooth. This is not what's driving the market right now. China and coronavirus and earnings. Now, talking of earnings, Alibaba beat earnings, but why am I focusing on Alibaba? You know why. It's Chinese. You got exposure to the coronavirus. So earnings beat estimates, not by a huge percentage, but they beat it by 0.2%. 38% increase in revenue growth, but let's look at the stock. The stock is going to open down about 2.5%. Also, the stock failed to make new highs. This is let me draw this for you. You'll see my beautiful drawing skills here. Let me do this here. That, my friends, is a triangle. It's a symmetrical triangle. And triangles can break in either direction when they're symmetrical. In this case, because we failed to take out the high and we're breaking lower by 217, right in this ballpark, it looks like it's going to break lower. And I wouldn't doubt it either, simply because of this coronavirus. This company is literally a Chinese company dealing with coronavirus, not dealing with coronavirus, but trying to battle its way through the coronavirus. And this virus may impact the economy for the next 2 or 3 quarters. I'm not kidding. It really can. So keep your eye out on Alibaba and other Chinese stocks. Another stock that came out with earnings, again, this is not a Chinese stock, but I wanted to show you because a lot of people are looking at the stock. It's Aurora Cannabis. The company came out with a net revenue of $66 million, not very much out of line with expectations. And the stock, let me show you the chart of the stock. So you can see how it's looking technically. This is the chart of Aurora Cannabis. It's not looking pretty. The stock price has been going down. It's going to be opening down a little bit more. I would not be a buyer of the stock. I would wait for the stock to trade above the 50-day moving average. Let me show you where the averages are so you can gain a good idea. It's already there. I would wait for the stock. I would wait for the 50-day moving average to cross the 200-day moving average. Then I would wait for price action to trade above. As of right now, the only thing I would consider and highlight is waiting for a pullback to the 50-day moving average or maybe to the twilight zone and then breaking lower once again. So I'm not seeing a massive move to the upside in Aurora Cannabis. Alibaba, as I said before, it's a symmetrical triangle, and the fact that we failed to take out the top and we're breaking lower after better than expected earnings is telling me that there's a good chance we may come down to the 200-day moving average or to the twilight zone, which is between the 50-day and the 200-day moving average, and then the stock may be coming back up. So again, better than expected numbers with Alibaba, but no upside. Worse than expected number or neutral numbers with Aurora, but no upside for the stock at all. Looking at the broad market, important. Pay attention. This is really important. This is the put to call ratio. Typically, the put to call ratio is useless. It's random. It's like a rubber band that gets stretched out like this and it comes back. But sometimes that rubber band gets stretched out like this. So whenever you see the put to call ratio below 75, that means the bull market, the bullish trend, the bullish sentiment is over. It's just too much. Markets are a bit too complacent. All right. There's too many bulls. There's too many bulls in the market. I know it sounds funny, but that's what it means. It means the markets are a little too neutral, a little too complacent, a little too happy, a little too stretched out. Now, on the other hand, if the put to call ratio goes to about 120, that means the market is scared. That means traders are buying puts. There's a lot of fear in the market. So anything below 75, and this is the overall put to call ratio that tracks the entire stock market. If you go to stock charts, the ticker symbol is $CPC. This is free information. It doesn't cost anything. I want you guys to use the same information that I do. Then you can apply it to your trading platform. But first, I want you to understand and look at all the indicators and make sure that the ones I'm using are matching up with your trading platform. This is why I'm doing this. This is why I'm not using a trading platform, because every trading platform uses different ticker symbols. I'd rather you get used to what I'm doing here and then apply it to your platform. So again, anything below 75 is telling us that bulls are a little too bullish, if you know what I mean. And anything above 120, 125 is telling us that the market is scared. And right now we're at 0.70, and it's telling us the market is a bit bullish, a little over bullish. Now, if we look at the chart of the S&P 500, let me look at the interactive chart. The market's cooling off a little bit. As I said yesterday, we have higher prices here up to yesterday, and we have momentum levels that are lower. The RSI could not go higher and take out these levels here because momentum just couldn't generate it. And that's telling us the market is overbought. All right, overbought. This indicator here, this put to call ratio, and the divergence that we're seeing between the price action and the oscillator, it's telling us that the market is overdone. Now, let me look at the bond market for you. Bond market's expected to go a little higher. We may stay in this trading range. Keep your eye out on the 145 level or 146 level on the TLT. I'm looking at the TLT. I could use the long bond. Here, let me just show you the long bond. It trades exactly the same way, and I know a lot of you guys don't want to look at futures contracts, but if you do trade futures contracts, you would be looking pretty much at the same thing that I'm looking at. Let me show you. This is the futures contract. And again, notice, same congestion. If you're looking at the futures contract, then you would want to look, this is the 10-year, no, actually this is the 30-year. This is the 30-year bond. If you're looking at the 30-year bond, the level you'd want to look at is above 164.05. I believe we're going to congest, go lower, and take out the 50-day line. I believe the trend is going to go lower because I don't think this coronavirus, personally, I don't think this coronavirus is going to expand too much further. I'm being hopeful here. I'm being hopeful. And earnings are better than expected, which means stocks will probably move higher once again after the next few days. We need to slow down desperately because stocks are overbought. But with that said, I believe bonds will go lower. Fed has no interest in raising interest rates right now. They have interest in keeping interest rates alone. Bonds and interest rates are inverse with each other, which means if bonds go lower, interest rates will go higher. The last two times the Fed has lowered interest rates, bonds did not go higher. They went lower. They went lower, okay? That's not how it's supposed to be done. So the bond market, the long bond market, is not listening to the short-term interest rate market. It's doing its own thing, and it's predicting higher interest rates. Not by a huge margin. Don't get scared. Don't go taking your money out of the stock market. We're still going to be in a low interest rate environment for many, many years, in my opinion. But again, expect bond market to go lower, expect interest rates to go slightly higher, and expect stocks to cool off. This is the S&P 500, go back to the 50-day line, maybe the twilight zone, although it doesn't seem that way right now because earnings are almost over and this coronavirus doesn't seem to have a big impact. So I'm not seeing anything major, just a technical cool off to slow down the RSI, give the market a little bit of pause, and then go higher once again. Now, this is important. Pay attention. If you're having trouble navigating through this market, I recommend you check out my new training. It's really cool. Why? Because I talk about one of my favorite indicators. This indicator is available on every technical analysis platform. And it doesn't just tell you what happened in the past. Like this moving average here, it's telling us what already happened. It's a good guide as an overall guide. But I don't use these indicators to enter and exit the market. They're too slow. They're used as a broad barometer. That's what I'm using these indicators for. But if you want an actionable indicator that'll help you how to predict what happened in the future, I've got something for you. Here's the best part. You don't have to buy anything. Every trading software includes this indicator. I know it sounds too good to be true, but it's not, and it's actually really, really simple. It can help you increase your overall profit, decrease your risk, and most importantly, help you time your trades better, which means more profit in less time. Everybody wants that. If you want to learn about this indicator, if you want to get in on this, follow the link below. Again, let me just recap for you. One of my all-time favorite indicators doesn't just tell you what already happened, but it also tells you what could happen, all right? Every trading platform, every software has it. You already have this indicator. You just need to learn how to use it right. And again, it can help you substantially time your trades, increase your profit, decrease your risk, and have a higher probability of success. Follow the link below. Learn all about it now. Have a great day, guys. Talk to you soon. Oh, by the way, thank you for all the wonderful email and the feedback. Please send me an email. Let me know how you like these. support@marketgeeks.com. I really appreciate it, and I'll personally reply to you. Talk soon. Have a great day, everyone.